Hey there, book lovers and curious minds. Welcome to the Book Lounge, the ultimate spot where great books meet even greater conversations. Today, I've got a question for you. What if I told you there's a book that could forever change the way you think about investing? Imagine having the tools to navigate the chaos of the stock market with confidence, backed by decades of proven wisdom. Sounds like something you'd want in your corner, right? Well, that's exactly what we're tackling today. In this video, we're unpacking A Random Walk Down Wall Street by Burton G. Malkiel, a modern classic in the world of finance. Whether you're new to investing or a seasoned pro, this book will challenge everything you thought you knew about making your money grow. So, why stick around? Because by the end of this video, you'll understand the powerful strategy that has stood the test of time and why it could be the smartest path to financial success. Plus, you'll pick up practical insights that are as easy to apply as they are game-changing. Ready to uncover what makes this book a must-read for anyone looking to take control of their financial future? Let's get started. Chapter 1, Firm Foundations and Castles in the Air. The first chapter sets the stage for understanding the two fundamental approaches to valuing assets and navigating the financial markets. At its core, this chapter explores the contrasting philosophies that have driven investing strategies for generations: the firm foundation theory and the castle in the air theory. Both perspectives are not just methods, they're mindsets that shape how people think about the value of investments. The firm foundation theory. The firm foundation theory is built on the principle that every asset has an intrinsic value, like a rock-solid foundation beneath a building. This intrinsic value is determined by measurable factors such as earnings, dividends, growth potential, and interest rates. Investors following this theory believe that markets may swing wildly in the short term, but over time, prices gravitate toward an asset's true value. In essence, this approach views the stock market as a weighing machine, focused on the concrete fundamentals of a company. Adherents of this theory, think Benjamin Graham and Warren Buffett, base their strategies on rigorous analysis. They look for assets that are undervalued, buying when prices fall below intrinsic worth and selling when they exceed it. The chapter draws an important analogy here. Think of the firm foundation theory as being akin to buying a house. You'd consider the structure, location, and long-term potential of the property rather than speculating on what a future buyer might pay. It's about stability, logic, and measurable facts. The castle in the air theory. In stark contrast stands the castle in the air theory, which trades hard analysis for psychology. This perspective argues that the real driver of asset prices is not intrinsic value, but investor sentiment, what the collective market believes an asset is worth. This approach is about building castles in the air, where the value of an investment rests not on its foundation, but on the stories, expectations, and euphoria surrounding it. Investors who embrace this mindset focus on anticipating crowd behavior. They seek to buy assets when enthusiasm is just beginning to build and sell when the castle reaches its peak, before sentiment shifts. The value, in this case, is purely speculative, shaped by optimism, trends, and even fads. The chapter gives an example of speculative bubbles, such as the tulip mania of the 1600s, where tulip bulbs became absurdly expensive simply because people believed they could sell them for even more. These bubbles illustrate the dangers of castle-in-the-air thinking. When the air thins, the castle collapses. Yet, despite its risks, the theory isn't without merit. In the right hands, this strategy can yield profits by riding waves of market sentiment. But the chapter warns that the same waves that carry you up can also drag you under. The intersection of the two. One of the most striking insights from this chapter is how these theories, while seemingly opposite, often overlap in practice. Intrinsic value investors can still be swayed by the emotional whims of the market, and speculative traders can stumble upon assets that genuinely possess strong fundamentals. This duality is what makes investing both an art and a science. A purely rational approach can miss opportunities created by human emotion, while a purely speculative mindset can lead to devastating losses when the euphoria ends. The chapter suggests that investors must understand both theories to navigate the market intelligently. Knowing the firm foundation theory equips you to evaluate an asset's true worth, while grasping the castle in the air theory helps you anticipate how others might behave. Why it matters. Understanding these theories is more than an intellectual exercise. It's a survival skill for anyone looking to invest. The firm foundation theory reminds us to stay grounded, urging us to look at the numbers and avoid the allure of hype. Meanwhile, the castle in the air theory is a sobering reminder that markets are driven by people, and people are anything but predictable. This chapter challenges us to ask tough questions about our own investing habits. Are we buying because an asset is undervalued, or because we think someone else will pay more for it tomorrow? Are we anchored in reality, or are we building castles in the air, hoping they won't crumble? Final thoughts. The clash between firm foundations and castles in the air isn't just a theoretical debate. It's the pulse of every market, every stock, and every financial decision. Whether you're a cautious realist or a daring speculator, understanding these two perspectives is essential. The chapter leaves us with a profound realization. Successful investing requires balancing rationality with awareness of the irrational. By mastering both the foundation and the castle, we can navigate the unpredictable world of finance with clarity and confidence. Chapter 2. The Madness of Crowds. This chapter takes a fascinating dive into one of the most unpredictable forces driving financial markets, collective human behavior. The focus is on the irrationality that emerges when crowds, driven by greed, fear, and herd mentality, act in unison, often ignoring logic and reason. It reveals how groupthink can lead to speculative bubbles, financial disasters, and the wild, chaotic swings of the market. Half the anatomy of speculative bubbles. Speculative bubbles are at the heart of this chapter, and their anatomy is dissected in detail. A speculative bubble occurs when the price of an asset, be it stocks, real estate, or even something as trivial as tulip bulbs, skyrockets far beyond its intrinsic value, fueled by mass euphoria. Everyone becomes convinced that prices will keep rising forever, and rational analysis gets thrown out the window. But bubbles always burst. The chapter illustrates this universal truth with vivid examples from history, highlighting how financial markets have repeatedly fallen victim to the madness of crowds. The tulip mania of the 1600s. One of the most iconic stories of financial folly is the tulip mania that gripped the Netherlands in the 17th century. Tulip bulbs became symbols of wealth and status, and their prices surged astronomically. People sold homes, borrowed money, and poured their life savings into tulip bulbs, all in the belief that someone else would pay even more tomorrow. The bubble eventually burst spectacularly. When reality caught up with speculation, prices collapsed, leaving many ruined. This episode is a stark reminder of how irrationality can overtake an entire society, even over something as simple as flowers. The South Sea Bubble. Another cautionary tale explored in this chapter is the South Sea Bubble of the 18th century. The South Sea Company promised extraordinary riches through trade with South America, and its stock prices soared on hype and inflated expectations. Investors, seduced by dreams of easy wealth, rushed in without questioning the company's actual prospects. When the truth emerged that the company's claims were largely baseless, the bubble popped, and fortunes were wiped out overnight. The chapter uses this example to demonstrate how seductive promises of quick riches can cloud even the most rational minds. The psychology of crowds. The chapter doesn't just recount historical anecdotes, it delves into the psychology behind the madness. Why do people get swept up in speculative frenzies? The answer lies in our deep-seated desire to follow the herd. When prices rise rapidly, fear of missing out, FOMO, grips investors. Rational individuals begin to act irrationally, convinced that this time is different. The crowd's behavior reinforces itself in a vicious cycle. Rising prices attract more buyers, which pushes prices even higher. Optimism turns into euphoria, and euphoria blinds people to risk. But just as greed drives the bubble, fear drives the collapse. The moment cracks begin to appear, when prices stop rising as expected, panic sets in. Everyone rushes to sell at the same time, turning the frenzy of buying into a frenzy of selling. Modern parallels. While historical examples like tulip mania and the South Sea Bubble may seem distant, the madness of crowds is far from ancient history. The chapter draws parallels to more recent speculative bubbles, such as the dot-com boom of the late 1990s and the housing market crash of 2008. During the dot-com bubble, investors poured money into internet companies, many of which had no profits or even revenue, on the assumption that the internet would revolutionize everything. When reality couldn't keep up with the hype, the bubble burst, wiping out trillions in market value. Similarly, the 2008 housing market bubble was driven by irrational exuberance around real estate. Banks, investors, and homebuyers convinced themselves that home prices would rise indefinitely, leading to reckless lending and borrowing. The subsequent crash sent shockwaves through the global economy. Lessons from the madness. The key takeaway from this chapter is that markets are not always rational. Human psychology plays a powerful role, and it often leads to overreactions on the way up and on the way down. The madness of crowds can create opportunities, but it can also be devastating for those caught in its grip. Investors are reminded to stay grounded, avoid chasing trends, and resist the urge to follow the herd. When everyone around you is convinced that prices will only go higher, it's worth pausing to ask, is this based on reality, or am I caught in a speculative bubble? Sobering insights. This chapter isn't just a cautionary tale, it's a call to self-awareness. It challenges us to recognize our own susceptibility to groupthink and emotional decision-making. The madness of crowds is not just something that happens to others. It can ensnare anyone who lets emotion overrule logic. Understanding the patterns of speculative bubbles and the psychology behind them equips investors to see through the hype and make rational decisions. It also reinforces the importance of sticking to fundamentals and questioning the crowd's behavior, even when it seems like everyone else is profiting. Final thoughts. The madness of crowds is a timeless phenomenon, as relevant today as it was during the tulip mania of centuries past. This chapter serves as a compelling reminder that markets, at their core, are driven by people, and people are emotional, fallible, and prone to extremes. Recognizing these tendencies is the first step toward navigating markets with clarity and avoiding the pitfalls of herd mentality. Chapter 3, Stock Valuation from the 60s through the 90s. This chapter serves as both a history lesson and a cautionary tale, chronicling the evolving trends in stock valuation from the 1960s through the 1990s. It reveals how markets are shaped by changing narratives, innovation, and investor psychology, as well as how these forces can drive valuations to extreme highs or devastating lows. By walking through the booms and busts of these decades, the chapter uncovers valuable lessons about the dangers of speculation and the enduring importance of rational investing. The go-go years of the 1960s. The 1960s were defined by the go-go years, a period of rapid economic expansion, optimism, and speculative fervor. Mutual funds were gaining popularity, and aggressive fund managers became stock market celebrities. These managers focused on high-growth companies, often paying astronomical prices for shares of firms in hot industries such as technology and electronics. The speculative frenzy during this period was driven by the belief that growth stocks, companies with rapidly rising earnings, would continue to skyrocket indefinitely. Investors abandoned traditional metrics like dividends and book value, focusing instead on potential future growth. The chapter points to the rise and fall of conglomerates as a hallmark of this era. These companies grew rapidly by acquiring unrelated businesses, often using questionable accounting practices to inflate earnings. While their stocks initially soared, many conglomerates eventually collapsed under the weight of their overvalued acquisitions, leaving investors with significant losses. The lesson? Even during times of economic optimism, inflated expectations and unsustainable valuations can spell disaster for investors who chase hype over substance. The Nifty 50. In the late 1960s and early 1970s, the Nifty 50 stocks took center stage. These were large blue-chip companies like IBM, Xerox, and Polaroid, hailed as one-decision stocks because investors believed they could be bought and held forever. What made the Nifty 50 unique was the belief that these companies were immune to economic downturns due to their dominance in their industries. As a result, their valuations soared to extraordinary levels, with some stocks trading at price-to-earnings PSY-E ratios exceeding 50, numbers that would typically be considered dangerously high. The chapter explains how this bubble burst during the bear market of the early 1970s. Despite their impressive track records, even the Nifty 50 couldn't escape the realities of overvaluation. Investors who bought at the peak faced years of poor returns. This period serves as a reminder that even the strongest companies can become overvalued, and no stock is immune to the laws of market gravity. The price you pay matters, no matter how impressive the underlying business may seem. Tash with the crash of 1987. The 1980s brought renewed enthusiasm for stocks, driven by economic growth, deregulation, and advancements in technology. However, this optimism culminated in one of the most infamous events in market history, the crash of October 1987, when the Dow Jones Industrial Average plummeted by 22% in a single day. The chapter delves into the factors that contributed to this sudden collapse, including computerized trading strategies like portfolio insurance, which were supposed to minimize risk, but instead amplified selling pressure during the crash. What's striking about this event is that it wasn't driven by a fundamental economic crisis. Instead, it was a case of market psychology and technical factors spiraling out of control. The crash of 1987 highlighted the market's vulnerability to rapid shifts in sentiment and the unintended consequences of complex financial innovations. The takeaway: markets can swing wildly, even without major economic reasons, and investors must prepare for the unexpected. Diversification and long-term perspective remain critical safeguards against these shocks. Trash, the dot-com boom of the 1990s. The chapter concludes with the explosive growth of the 1990s, a decade marked by technological innovation and the rise of the internet. The dot-com boom was fueled by the belief that the internet would revolutionize every aspect of business and society. Investors poured money into tech startups, often ignoring traditional measures of value like profits, cash flow, or even revenues. Stocks of companies with no viable business models soared to astronomical levels simply because they had a "com" in their name. Valuation metrics like P/E ratios became irrelevant as speculation drove prices ever higher. The chapter emphasizes the sheer scale of the mania, likening it to earlier speculative bubbles. By the late 1990s, it seemed like every investor wanted a piece of the tech sector, and skepticism was drowned out by euphoria. Of course, the bubble eventually burst in 2000, leading to a dramatic collapse in tech stocks. Trillions of dollars in market value evaporated, and countless investors were left nursing heavy losses. Key lessons from decades of euphoria. What ties these decades together is the recurring pattern of human behavior. Time and again, investors have abandoned rationality, chasing the promise of easy money and getting swept up in the excitement of the crowd. Whether it's the conglomerates of the 1960s, the Nifty 50, or the dot-com boom, the same mistakes keep repeating: overpaying for growth, ignoring fundamentals, and believing that this time is different. The chapter challenges readers to rise above the madness. Successful investing requires discipline, patience, and a healthy skepticism of popular trends. Markets may change, but human nature does not, and recognizing these patterns is essential to avoiding costly mistakes. Final thoughts? The history of stock valuation from the 1960s to the 1990s is a vivid reminder that markets are driven as much by psychology as by economics. Understanding this history isn't just about avoiding the mistakes of the past, it's about recognizing the signs of speculation and staying grounded in a world that often thrives on irrational exuberance. For the disciplined investor, this chapter provides invaluable insights into navigating both the booms and the busts. Chapter 4, the biggest bubble of all, surfing on the internet. This chapter examines one of the most extraordinary periods in modern financial history, the dot-com bubble of the late 1990s and early 2000s. It vividly captures the euphoria, irrationality, and ultimate collapse of a speculative mania fueled by the rise of the internet. At its core, the chapter is a lesson in how innovation and promise can ignite dreams of boundless profits and how those dreams can quickly spiral into financial chaos. The promise of the internet. The internet was heralded as the technological revolution of the century, a force that would transform industries, redefine business, and reshape everyday life. This optimism was not unwarranted. The internet did revolutionize communication, commerce, and information sharing. Companies like Amazon and eBay introduced new ways of doing business, while startups in Silicon Valley captured imaginations with promises of limitless growth and innovation. As a result, the stock market became a feeding frenzy for anything related to the internet. Investors clamored to buy shares in internet-based companies, many of which had no profits, no revenue, and in some cases, no clear business model. The focus wasn't on financial fundamentals, it was on the future. The belief was that these companies were riding a once-in-a-lifetime wave of technological disruption, and anyone who hesitated to invest would be left behind. Phrases like the new economy and disruption became rallying cries, as if the rules of valuation no longer applied. The rise of dot-com companies. During this period, the term dot-com became synonymous with wealth and success. New internet startups were going public at an astonishing rate, and their stock prices often soared within hours of trading. Initial public offerings, IPOs, became spectacles, with companies doubling or tripling their valuations in a single day. Many of these businesses didn't need to show profits or even revenue to attract investors. The thinking was that success in the internet age didn't require immediate returns. Instead, what mattered was capturing market share and eyeballs, or the number of users visiting a website. Investors believed that profitability would eventually follow. One notable example was Pets.com, an online pet supply retailer that spent millions on advertising and became famous for its sock puppet mascot. Despite its popularity, the company failed to generate sustainable revenue and collapsed within a year of going public. It became a symbol of the excess and irrationality of the dot-com era, a climate of irrational exuberance. The chapter delves into the psychology of the bubble, explaining how the market was driven by a mix of greed, fear of missing out, and overconfidence. Traditional valuation metrics like price-to-earnings (PE) ratios were dismissed as outdated relics of the old economy. Investors ignored basic principles of finance, believing that internet stocks would continue to rise indefinitely. The media amplified this frenzy with glowing reports of overnight millionaires and the meteoric rise of tech stocks. Financial analysts often played along, issuing optimistic predictions to justify the sky-high valuations. It was a self-reinforcing cycle. Rising stock prices fueled more hype, which attracted more investors, pushing prices even higher. This mania wasn't limited to professional investors. Everyday people, many with little knowledge of the stock market, poured their savings into dot-com stocks. Day trading became a cultural phenomenon, and some even quit their jobs to trade internet stocks full-time, convinced they had found a surefire path to wealth. The inevitable crash. By the early 2000s, cracks began to appear. Investors started questioning the sustainability of businesses that burned through cash with no clear path to profitability. Once optimism gave way to skepticism, the bubble began to deflate. The collapse was swift and brutal. Many dot-com stocks lost 90% or more of their value in a matter of months. Companies that had been worth billions on paper vanished almost overnight. The Nasdaq index, which had soared to unprecedented heights during the bubble, plummeted by nearly 80% between 2000 and 2002. The aftermath was devastating for investors. Trillions of dollars in wealth evaporated, retirement accounts were wiped out, and countless dreams of financial independence were shattered. The collapse served as a painful reminder of the dangers of speculation and the importance of sticking to fundamentals. Lessons from the biggest bubble. The chapter underscores the importance of distinguishing between genuine innovation and speculative excess. While the internet revolution was real and has since delivered enormous economic and societal benefits, the bubble it created was built on unsustainable expectations. One key takeaway is the danger of believing that this time is different. Investors often convince themselves that new technologies justify abandoning traditional valuation principles. But history shows that the basic rules of investing, like focusing on earnings, cash flow, and sustainable growth, are timeless. Another lesson is the role of psychology in financial markets. The dot-com bubble was driven by collective euphoria and the fear of missing out. Recognizing these emotional triggers can help investors avoid getting swept up in speculative frenzies. Finally, the chapter emphasizes the need for diversification and caution. Even during periods of rapid innovation, it's crucial to remember that not every company will succeed. The internet ultimately transformed the world, but many of the companies that drove the bubble didn't survive. Final thoughts. The dot-com bubble was a defining moment in financial history, a story of extraordinary promise and extraordinary folly. While the internet revolution has since lived up to its potential, the bubble that surrounded it serves as a stark reminder of the perils of unchecked optimism and irrational exuberance. For investors, the lessons of this era remain as relevant today as ever. Stay grounded, question the hype, and never lose sight of the fundamentals. Chapter 5. Technical and Fundamental Analysis. This chapter delves into two of the most prevalent approaches to evaluating and selecting stocks: technical analysis and fundamental analysis. These methodologies represent contrasting schools of thought, each with its devoted following and unique set of assumptions. The narrative critiques and examines both methods, exploring their strengths, limitations, and relevance in modern investing. The art of technical analysis. Technical analysis is often described as the pursuit of patterns in chaos. It relies on the belief that past price movements and trading volumes hold the key to predicting future price trends. Technical analysts, often called chartists, eschew fundamental data about a company's performance, such as revenue, profit, or market conditions. Instead, they focus solely on price charts and patterns, employing tools like moving averages, support and resistance levels, and momentum oscillators. Proponents argue that market prices reflect all relevant information, including investor psychology, and that these behavioral patterns repeat over time. The patterns identified, head and shoulders, double tops, triangles, are believed to signal bullish or bearish trends, guiding investors on when to buy or sell. However, the chapter raises compelling doubts about the efficacy of technical analysis. Markets, influenced by thousands of unpredictable variables, are rarely so obliging as to repeat exact patterns. Price movements can be random, making it nearly impossible to discern whether a perceived trend is truly actionable or merely a coincidence. While technical analysis may succeed in identifying short-term momentum, it often fails to consistently deliver long-term success. The randomness of stock prices, the random walk hypothesis, casts significant skepticism on the predictive power of charting alone. The science of fundamental analysis. In contrast to technical analysis, fundamental analysis digs deep into the intrinsic value of a stock by evaluating a company's financial health, competitive position, and growth prospects. Fundamental analysts believe that the stock market does not always price companies correctly, creating opportunities to buy undervalued stocks or sell overvalued ones. This method involves studying balance sheets, income statements, management strategies, industry trends, and macroeconomic factors. The approach is rooted in the belief that a company's value can ultimately be traced to its earnings power and potential to generate cash flows. By assessing metrics like earnings per share (EPS), price to earnings (PE) ratios, and debt to equity ratios, fundamental analysts aim to determine whether a stock is trading below or above its intrinsic value. The chapter acknowledges that fundamental analysis has an intellectual appeal. It is systematic, data-driven, and seemingly grounded in rational economics. Yet, even this disciplined approach has its pitfalls. Predicting future earnings or the success of a company's strategy is fraught with uncertainty. Furthermore, markets often take time to reflect a company's true value, testing the patience and resolve of investors. Behavioral biases and unforeseen disruptions can further derail even the most carefully calculated predictions. When belief meets reality, the chapter critically examines the challenges that both technical and fundamental analysts face. One striking argument is that in highly efficient markets, prices already incorporate all available information, leaving little room for either method to consistently outperform. This efficiency means that any potential mispricing is quickly corrected as investors act on new information. Moreover, the complexity of the modern financial world complicates both approaches. Technical analysis can be swamped by false signals in volatile markets, while fundamental analysis can be rendered irrelevant by sudden disruptive events. For example, a company might look fundamentally strong on paper but suffer from unexpected regulatory changes or technological shifts. Similarly, chart patterns can break abruptly in response to external shocks. The chapter also highlights the influence of behavioral finance on both methods. Investor emotions, fear, greed, overconfidence, can lead to irrational market behaviors that defy both technical trends and fundamental logic. This unpredictability further underscores the difficulty of achieving consistent success using either strategy in isolation. A middle ground? While technical and fundamental analysis are often framed as opposing philosophies, the chapter suggests that they can be complementary tools. Technical analysis may help in identifying short-term market sentiment or entry and exit points, while fundamental analysis provides a long-term perspective on intrinsic value. Combining the two, when done judiciously, can offer a more holistic view of an investment opportunity. For instance, an investor might use fundamental analysis to select a stock with strong growth potential and sound financials. Then, technical indicators can be employed to determine the optimal timing for buying or selling. This hybrid approach seeks to balance the and weaknesses of both methods, acknowledging that no single strategy holds all the answers. The takeaway. Ultimately, the chapter argues that neither technical nor fundamental analysis offers a foolproof path to investment success. Both require significant time, expertise, and a tolerance for uncertainty. The unpredictability of markets, coupled with the influence of human behavior, ensures that even the most rigorous analysis cannot guarantee returns. For the average investor, the lesson is clear. Chasing trends or overanalyzing data can often lead to disappointment. Instead, a disciplined, diversified, and long-term approach, perhaps one that incorporates elements of both strategies, may yield the best results. Patience, humility, and an understanding of market dynamics are the most valuable tools an investor can possess. In conclusion, while the allure of technical patterns and fundamental insights is undeniable, investors must remember that markets are complex, dynamic, and often irrational. Success lies not in predicting the unpredictable, but in managing risk, staying informed, and maintaining a clear focus on long-term goals. Chapter 6: Technical Analysis and the Random Walk Theory. This chapter takes a critical and thought-provoking look at technical analysis, dissecting its principles, methodologies, and effectiveness while juxtaposing it with the random walk theory, a concept that challenges its very foundation. By exploring the allure and limitations of technical analysis, the chapter prompts readers to reconsider whether patterns in stock price movements are truly the road to riches or simply illusions in the noise of randomness. The essence of technical analysis. At its core, technical analysis is built on the idea that historical price movements and trading volumes provide all the clues needed to predict future trends. Practitioners, often referred to as chartists, believe that patterns repeat over time due to the collective psychology of investors. Through charts, they identify formations such as head and shoulders, double tops, and flags that supposedly signal market direction. They also rely on tools like moving averages and momentum indicators to fine-tune predictions. The appeal of technical analysis lies in its simplicity and accessibility. It offers the promise that one can profit from the markets without deep knowledge of a company's operations, balance sheet, or competitive environment. All you need to know, advocates argue, is in the price charts. The allure of market predictability. The chapter delves into why technical analysis captivates so many investors. Its visual nature makes it easy to grasp. The idea of spotting a pattern and acting on it feels intuitive and empowering. Moreover, it aligns with the human tendency to search for order amidst chaos. Markets, with their fluctuating prices, often feel inscrutable, and the promise of technical analysis is the promise of clarity, a belief that there's a map hidden within the madness. But does this promise hold up under scrutiny? The random walk theory strikes back. The random walk theory challenges the fundamental premise of technical analysis. This theory posits that stock price movements are inherently random and unpredictable. Because markets are efficient, all known information about a stock is already reflected in its price. This means that any patterns or trends identified in charts are at best coincidental and at worst outright misleading. The chapter draws on empirical studies that reveal the shortcomings of technical analysis. Research has shown that stocks do not consistently follow the patterns predicted by chartists. A head and shoulders formation may lead to a price drop one day, but fail to do so the next, rendering its predictive power unreliable. In the long run, the chapter argues, any apparent successes of technical analysis are often the result of luck rather than skill. The case of data mining. One of the most compelling criticisms explored in this chapter is the issue of data mining. With enough data and creativity, patterns can always be found, even in random sequences. For instance, given a set of historical stock prices, one could discover a pattern simply because the human brain is wired to seek connections. However, such patterns are often artifacts of overfitting, meaning they lack any meaningful predictive power when applied to new data. The random walk theory warns against falling into the trap of seeing order where none exists. By believing too strongly in the reliability of technical analysis, investors risk making decisions based on noise rather than substance. Why technical analysis still persists. If technical analysis is so flawed, why does it continue to attract a devoted following? The chapter offers several insights. 1. Behavioral biases. Investors are naturally drawn to the idea of controlling uncertainty. The visual appeal of technical charts and the comforting logic of patterns can override skepticism. 2. Confirmation bias. Practitioners tend to remember their successes while conveniently forgetting their failures, reinforcing their belief in the method. 3. Momentum effects. In the short term, markets can exhibit momentum, where rising prices attract more buyers and falling prices attract more sellers. Technical analysis may appear to work during such periods, though these effects are often temporary and unreliable in the long term. 4. Entertainment value. An often overlooked reason is that technical analysis makes investing exciting. The process of interpreting charts and making rapid trades injects an element of gamification into the experience, which can be addictive even if it's not profitable. Lessons for investors. The chapter doesn't entirely dismiss technical analysis, but encourages readers to approach it with caution and skepticism. It acknowledges that while some charting techniques might capture short-term trends driven by investor sentiment, the method fails to provide a consistent edge over the long term. Instead, the random walk theory urges investors to adopt a more disciplined and systematic approach. Rather than chasing patterns or trends, the focus should be on building a diversified portfolio, minimizing costs, and staying invested over time. Markets may be unpredictable, but their overall growth trajectory rewards those who exhibit patience and restraint. The bottom line: the clash between technical analysis and the random walk theory boils down to a fundamental question. Is the market a game of skill or a game of chance? This chapter leans firmly toward the latter perspective, emphasizing that while the allure of charting is strong, its efficacy is highly questionable. The unpredictability of markets, coupled with their inherent efficiency, means that investors are better served by focusing on strategies grounded in evidence and long-term principles, rather than the fleeting promises of technical analysis. Ultimately, the chapter is a call to action for investors to resist the seduction of shortcuts and embrace the reality of uncertainty. Investing is not about predicting the unpredictable, but about navigating it with wisdom, resilience, and a steady focus on the bigger picture. Chapter 7. How good is fundamental analysis? This chapter embarks on an incisive examination of fundamental analysis, questioning its effectiveness in delivering consistent investment success. Often touted as the cornerstone of rational investing, fundamental analysis involves scrutinizing a company's financial health, industry position, and growth prospects to determine whether a stock is undervalued or overpriced. But does it hold up under scrutiny? The chapter exposes the strengths, limitations, and pitfalls of this approach, offering an enlightening perspective for investors seeking clarity in the chaotic world of finance. The case for fundamental analysis. Fundamental analysis has long been hailed as the logical, data-driven alternative to speculative trading. Its appeal lies in its depth and precision, an approach that delves into a company's financial statements, evaluates its earnings, revenue growth, debt levels, and even management quality. It's a method rooted in the belief that a stock's true value or intrinsic value can be calculated, and any discrepancies between this value and the market price present opportunities for profit. Fundamental analysis also takes into account broader economic factors like interest rates, inflation, and market trends, making it a comprehensive tool. The logic is compelling. By buying stocks priced below their intrinsic value, investors can potentially ride the wave of market corrections to reap significant returns. This approach has been championed by investment legends who have built fortunes on its principles. It encourages patience and discipline, emphasizing long-term growth over short-term gains. For many, fundamental analysis represents the epitome of rational investing, a stark contrast to the speculative frenzy of market timing or technical chart watching. Limitations of fundamental analysis. However, the chapter doesn't shy away from exposing the flaws that undermine this revered approach. The first and perhaps most striking criticism is that intrinsic value itself is an elusive concept. Predicting a company's future earnings and cash flows requires assumptions about growth rates, market conditions, and consumer behavior, variables that are highly unpredictable. Even the most seasoned analysts, armed with sophisticated models, are vulnerable to error. Compounding this challenge is the issue of information asymmetry. While large institutional investors have access to advanced data and resources, individual investors often operate at a disadvantage. And even when analysts are equipped with the same data, their interpretations can vary wildly. For every buy recommendation from one analyst, there's often a sell from another. The chapter also highlights how market efficiency erodes the advantages of fundamental analysis. In an efficient market, stock prices already reflect all publicly available information, making it nearly impossible to consistently identify undervalued or overvalued stocks. Any perceived mispricing is quickly corrected as thousands of investors compete to exploit the same opportunities. The role of human error. One of the most thought-provoking sections of the chapter delves into the role of human error in fundamental analysis. The complexity of analyzing financial data often leads to overconfidence among analysts, who mistakenly believe their insights are more reliable than they are. This overconfidence can result in poor investment decisions, as investors place undue faith in their predictions. Furthermore, bias and emotion can cloud judgment. Analysts may overemphasize recent events, overlook warning signs, or cling to outdated assumptions about a company's potential. The chapter underscores how herd mentality exacerbates this issue, as analysts and investors alike are influenced by consensus opinions rather than independent reasoning. Do analysts really add value? The chapter presents a sobering analysis of the actual track record of professional analysts. Despite their expertise, most analysts fail to outperform the market. Studies have shown that their earnings forecasts, while detailed, are often inaccurate. Even when analysts succeed in identifying undervalued stocks, the benefits are often short-lived, as the market quickly adjusts prices to reflect new information. Another criticism is the inherent conflict of interest in the financial industry. Analysts working for brokerage firms or investment banks may face pressure to issue optimistic recommendations to attract business or maintain relationships with the companies they cover. This conflict can compromise the integrity of their analyses, leaving investors with skewed or overly rosy projections. The competitive market hypothesis. The chapter ties these criticisms to the broader framework of the competitive market hypothesis, which asserts that stock prices are driven by intense competition among informed investors. This competition ensures that prices reflect all available information, leaving little room for fundamental analysis to uncover hidden opportunities. Even if a stock is undervalued, the market's unpredictability means that its price may take months or even years to align with its intrinsic value, an agonizing wait for investors seeking immediate results. In some cases, the market may never fully recognize a stock's true worth, as external factors like economic conditions or industry disruptions overshadow its fundamentals. Despite its critiques, the chapter doesn't entirely dismiss fundamental analysis. It acknowledges that when used prudently, it can help investors avoid glaring mistakes, such as overpaying for hype-driven stocks or neglecting solid companies with strong financials. Fundamental analysis can provide a foundation for making informed decisions, particularly for long-term investors who prioritize stability over speculation. However, the chapter urges readers to temper their expectations. Fundamental analysis is not a crystal ball, and its limitations must be recognized. Successful investing requires more than just financial ratios. It demands diversification, patience, and an acceptance of the inherent unpredictability of markets. Key takeaways. 1. Intrinsic value is hard to pinpoint. Predicting future earnings and growth involves significant uncertainty, making valuations inherently subjective. 2. Market efficiency levels the playing field. In competitive markets, prices quickly reflect all available information, diminishing the advantages of fundamental analysis. 3. Analyst bias and overconfidence are real risks. Even professional analysts are prone to errors and conflicts of interest. 4. Long-term focus is essential. While fundamental analysis can provide insights, its effectiveness is often tied to a long-term investment horizon. Final thoughts. This chapter offers a sobering yet balanced view of fundamental analysis, challenging its reputation as the ultimate investment tool while recognizing its value as part of a broader strategy. It serves as a reminder that the stock market is a dynamic, unpredictable system where no single approach guarantees success. Instead of seeking perfection in any one method, investors are encouraged to combine the principles of fundamental analysis with humility, diversification, and a clear-eyed understanding of market realities. Chapter 8, A New Walking Shoe, Modern Portfolio Theory. This chapter introduces a groundbreaking shift in investment thinking, modern portfolio theory, MPT. By marrying mathematics with investing, this theory revolutionized the way people view risk and return, teaching investors that it's not just about picking the right stocks, but about building a diversified portfolio that optimally balances risk and reward. It challenges conventional wisdom and empowers individuals to invest strategically, not emotionally, in an unpredictable market. The core idea: risk versus reward. At its heart, modern portfolio theory revolves around a simple yet profound principle. Every investment decision involves trade-offs between risk and return. Risk is unavoidable in the stock market, but MPT doesn't aim to eliminate it. Instead, it seeks to manage it intelligently. The chapter explains that most investors traditionally focused on individual stocks, searching for the elusive winners to maximize their returns. However, MPT demonstrates that what matters most is not the performance of individual assets, but how those assets interact within a portfolio. By carefully selecting a mix of investments, even seemingly risky ones, investors can reduce overall portfolio risk while maintaining attractive returns. This insight is transformative because it reframes risk not as an enemy, but as a tool. By understanding and controlling risk, investors can make decisions grounded in strategy rather than fear or speculation. The power of diversification. One of the cornerstone principles of MPT is diversification. The chapter vividly illustrates how a well-diversified portfolio can act as a shock absorber, smoothing out volatility and reducing the impact of any single investment's poor performance. The reasoning behind this is simple, yet profound. Different asset classes, stocks, bonds, real estate, and others, react differently to market forces. When one investment zigs, another often zags. By owning a variety of assets, investors can offset losses in one area with gains in another, minimizing risk without sacrificing potential returns. But diversification isn't just about owning many investments. The chapter emphasizes that it's about owning the right mix of assets, those with low or negative correlations. For example, pairing stocks from different industries or regions, or blending equities with safer investments like government bonds, creates a portfolio where risks are spread rather than concentrated. Risk is more than volatility. Traditionally, risk has been equated with volatility, the ups and downs of stock prices. But MPT challenges this oversimplification. The chapter introduces a more nuanced understanding of risk, rooted in the concept of standard deviation, which measures how much an investment's returns deviate from its average. In MPT, risk is quantified and embraced as part of a broader strategy. A portfolio with a higher standard deviation is deemed riskier because its returns are less predictable. However, the chapter underscores that risk isn't inherently bad. Higher risk portfolios often offer the potential for greater rewards as long as they align with the investor's goals and risk tolerance. By redefining risk in mathematical terms, MPT provides investors with a framework to evaluate their decisions more objectively. It allows them to think beyond gut feelings or headlines and instead focus on building a portfolio that aligns with their unique circumstances. The efficient frontier, the holy grail of investing. Perhaps the most compelling part of the chapter is the introduction of the efficient frontier, a concept that embodies the optimal balance of risk and return. Imagine a curve representing all possible portfolios, where each point reflects a combination of risk and expected return. Portfolios on this curve, known as the efficient frontier, deliver the highest possible return for a given level of risk. Anything below the curve is considered suboptimal because it provides less return for the same risk. This visualization transforms investing into a science, offering clarity and direction in a world often clouded by emotion and uncertainty. The chapter explains how MPT allows investors to construct portfolios that aim to hug the efficient frontier, maximizing the rewards of risk-taking while avoiding unnecessary exposure. The role of beta and correlation. The chapter delves deeper into two critical components of MPT, beta and correlation. Beta measures how much an investment's price moves in relation to the market as a whole. A stock with a beta greater than 1 is more volatile than the market, while one with a beta less than 1 is less volatile. Correlation, on the other hand, measures how assets move in relation to each other. Two investments with a correlation of 1 move in lockstep, while those with a correlation of -1 move in opposite directions. By understanding these metrics, investors can construct portfolios where risks are counterbalanced, creating more stability. MPT in action, the rise of index funds. The chapter connects MPT to the growing popularity of index funds. These funds, which track broad market indexes, embody the principles of diversification and efficiency. Instead of attempting to pick individual winners, index funds offer exposure to a wide array of investments, providing a low-cost way to capture market returns. The chapter argues that for most investors, index funds are a practical way to implement MPT in their portfolios. They simplify diversification, reduce costs, and eliminate the need for constant monitoring or active trading. Key takeaways. 1. The interplay between investments is more important than the performance of any single asset. 2. Diversification is a superpower. Spreading investments across uncorrelated assets reduces risk without sacrificing returns. 3. Risk is manageable. Embrace risk as part of the process and use tools like beta and correlation to make informed decisions. 4. Strive for efficiency. Aim for portfolios on the efficient frontier to maximize returns for the risk you're willing to take. 5. Index funds simplify MPT. For most investors, they are an accessible way to benefit from the principles of modern portfolio theory. Final thoughts. This chapter illuminates a profound truth. Successful investing is not about chasing the next big stock, but about constructing a portfolio that works harmoniously as a whole. Modern portfolio theory empowers investors to embrace the science of diversification, focus on the long term, and make decisions grounded in logic rather than emotion. It's a toolkit for navigating the complexity of the markets with confidence and clarity. Chapter 9, Reaping Reward by Increasing Risk. In this chapter, the focus shifts to the dynamic relationship between risk and reward in investing. It explores the fundamental concept that taking on more risk, when done strategically, can lead to higher potential returns. However, it also underscores the critical importance of understanding the nature of risk, how it can be measured, managed, and leveraged to optimize investment outcomes. This chapter isn't just about accepting risk, it's about embracing it wisely and strategically to unlock greater financial growth. The risk-reward trade-off. At the heart of this chapter lies the concept of the risk-reward trade-off. It's a principle that has been the bedrock of investing for centuries. The greater the risk you are willing to take, the greater the potential for higher returns. But how much risk is too much, and how can investors balance it with their desire for growth? The chapter explains that risk can manifest in many ways: market volatility, economic downturns, or sudden shifts in political landscapes. While these risks are unavoidable, they can be managed through diversification and an understanding of how different assets react to various market conditions. Yet the chapter goes deeper, showing how certain types of risk, when strategically incorporated into an investment strategy, can offer outsized rewards. The two types of risk: systematic and unsystematic. The chapter breaks down risk into two broad categories: systematic and unsystematic risk. Systematic risk refers to the risks that affect the entire market, such as recessions, inflation, or interest rate changes. These risks cannot be avoided through diversification, as they influence all investments to some extent. While they cannot be eliminated, understanding systematic risk allows investors to prepare and manage it more effectively. Unsystematic risk, on the other hand, is specific to individual assets or industries. It includes risks associated with a single company's management, product failures, or industry-wide challenges. The chapter highlights that this type of risk can be mitigated by diversifying one's portfolio. By holding a mix of assets, an investor can significantly reduce the potential impact of any single risk event. The key insight here is that to achieve higher returns, investors must recognize and accept systematic risk, as it is this type of risk that has the greatest potential to drive long-term growth. While unsystematic risk can be avoided, systematic risk, by its very nature, must be embraced and managed. This chapter introduces the concept of the risk premium, the extra return that investors demand for bearing additional risk. The risk premium is central to understanding why investors choose riskier assets, such as stocks, over safer ones like bonds or treasury bills. The basic idea is that investors expect to be compensated for taking on risk. Stocks, being more volatile and unpredictable than bonds, should provide higher long-term returns. The chapter explains that, historically, the risk premium for stocks has been significant, as they tend to outperform safer investments over the long term. However, this also means that stocks can suffer significant short-term losses during economic downturns, making it essential for investors to be patient and prepared for volatility. Strategic use of risk in portfolio construction. The chapter emphasizes that risk must be understood and strategically incorporated into an investor's portfolio. Simply taking on more risk isn't the solution. Rather, it's about recognizing the types of risks that align with an investor's financial goals and time horizon. For instance, younger investors with a longer time horizon can typically afford to take on more risk by investing heavily in stocks, as they have more time to recover from downturns. On the other hand, older investors nearing retirement may prefer to reduce their exposure to riskier assets and focus more on bonds and other stable investments. By aligning risk tolerance with financial objectives, investors can optimize the balance between risk and reward, ensuring that their portfolios are positioned to achieve the best possible returns while minimizing unnecessary exposure. The role of diversification in managing risk. Diversification is a cornerstone of risk management. The chapter makes it clear that while risk can never be completely eliminated, it can be mitigated. By spreading investments across different asset classes, industries, and geographical regions, investors can reduce the impact of any single risk event on their overall portfolio. The chapter highlights that diversification not only reduces unsystematic risk, but also smooths out the ups and downs of systematic risk. In other words, a diversified portfolio, while still exposed to the broader market's fluctuations, is less likely to experience extreme volatility. The strategy of diversification, then, is one of the most effective ways to increase returns without taking on excessive risk. The importance of long-term perspective. One of the key messages of this chapter is the value of maintaining a long-term perspective. Risk, by its nature, involves short-term volatility. Investors who panic during market drops or try to time the market often miss out on the long-term growth that higher-risk investments offer. The chapter stresses the importance of sticking to a strategy that aligns with one's goals and risk tolerance, especially when markets are turbulent. Short-term fluctuations are inevitable, but the long-term upward trend of well-managed, risk-aware portfolios has historically led to substantial wealth creation. Key takeaways. 1. Risk and reward are inseparable. To reap higher rewards, investors must be willing to embrace higher levels of risk. 2. Systematic versus unsystematic risk. Investors can mitigate unsystematic risk through diversification, but systematic risk is something that must be managed and accepted. 3. The risk premium. Riskier investments, such as stocks, demand higher returns to compensate for the additional risk they carry. 4. Strategic risk management. Risk should be carefully considered and aligned with financial goals, time horizons, and risk tolerance. 5. Diversification is key. By spreading investments across different asset classes and industries, investors can reduce risk and increase long-term returns. 6. A long-term view pays off. Successful investing requires patience, especially when navigating the inevitable volatility of the market. Final thoughts. This chapter offers a powerful reminder that risk is an essential part of the investment process. Rather than fear it, investors are encouraged to understand it, measure it, and use it strategically to enhance their returns. The path to financial success doesn't lie in avoiding risk, but in accepting it, managing it wisely, and building a portfolio that balances the potential for reward with a sound understanding of the risks involved. By doing so, investors can confidently navigate the ups and downs of the market, ultimately reaping the rewards that come with increasing risk in a controlled and strategic manner. Chapter 10: Behavioral Finance. In this chapter, the focus shifts to a revolutionary approach that blends psychology and finance, behavioral finance. While traditional finance theory assumes that investors are rational and always make decisions based on logic, behavioral finance suggests otherwise. It uncovers the many ways our emotions, biases, and mental shortcuts influence our financial decisions, often leading to irrational outcomes. The chapter delves deep into how these psychological factors can create market inefficiencies and how understanding them can lead to better investment strategies. The flaws in rational thinking. Traditional financial theory has always operated under the assumption that investors are rational. According to this view, individuals make decisions purely based on objective analysis, evaluating risks and rewards with clear-eyed precision. However, behavioral finance challenges this notion by revealing the irrational ways people behave when it comes to money. The chapter explains that human beings are not purely logical decision makers. Instead, they are prone to cognitive biases, emotional responses, and social influences that distort their judgment. These biases often lead to suboptimal investment choices, such as overreacting to market movements, buying high out of fear of missing out, or selling low in a panic during downturns. These irrational behaviors can result in significant losses or missed opportunities, even when the fundamentals of the market or the investment remain sound. The impact of overconfidence and herd behavior. One of the central themes of behavioral finance is the concept of overconfidence. The chapter illustrates how investors, buoyed by their own beliefs and experiences, often overestimate their ability to predict market movements. Overconfident investors may trade excessively, believing they have superior insight into the market. This overconfidence can lead to risky behaviors such as taking on too much risk or making speculative bets without fully understanding the consequences. The chapter also highlights herd behavior, where individuals tend to follow the crowd, especially in times of uncertainty. This psychological tendency often drives market bubbles, as investors collectively buy into an overvalued asset, pushing its price beyond reasonable expectations. The dot-com bubble and the 2008 financial crisis are both cited as examples of how herd behavior can lead to market distortions, creating unsustainable price increases followed by dramatic crashes. The fear of losing. Another powerful insight from behavioral finance is the concept of loss aversion. The chapter explains that humans feel the pain of a loss much more acutely than the pleasure of an equivalent gain. This psychological bias often causes investors to become overly risk-averse during market downturns. They may hold on to losing investments longer than they should, hoping to break even, or sell winning investments too quickly out of fear that gains will evaporate. Loss aversion leads to suboptimal decision-making because it can distort risk perception. Instead of making objective, balanced decisions, investors may act out of fear or frustration, undermining their long-term goals. The chapter suggests that understanding this bias can help investors better manage their emotions, stick to their investment strategies, and avoid falling into the trap of making impulsive decisions in response to short-term market fluctuations. Mental accounting. How we treat money differently. The chapter introduces the concept of mental accounting, where people treat money differently based on its source or intended use. For example, an investor might be more willing to take risks with money they consider to be windfall profits, such as an inheritance or bonus, while being overly conservative with money they've earned through hard work. This mental compartmentalization can lead to inconsistent investment behavior, as people might treat money from different sources as if it were not interchangeable, even though financially all money is the same. Mental accounting can also cause individuals to segment their investments into different buckets, rather than looking at their overall financial picture. This compartmentalization often leads to inefficient asset allocation, as investors fail to optimize their entire portfolio, focusing too heavily on one area while neglecting another. The role of framing and anchoring. Another key element discussed in the chapter is framing, which refers to the way information is presented and how that presentation influences decision-making. For example, if an investment is framed as having a 70% chance of success, it will likely seem more appealing than one framed as having a 30% chance of failure, even if the actual probabilities are the same. Framing can lead investors to make irrational choices based on the way a decision is worded rather than on its actual merits. The chapter also explores the concept of anchoring, where people rely too heavily on the first piece of information they encounter when making decisions. This bias can skew an investor's judgment. For example, if an investor buys a stock at $100 per share, they may irrationally anchor to that price, feeling they should hold on to it even if the company's fundamentals change, simply because they bought it at that price. This anchoring effect can prevent investors from adjusting their portfolios appropriately as new information emerges. The impact of behavioral biases on market inefficiencies. The chapter explores how these psychological biases, overconfidence, herd behavior, loss aversion, mental accounting, framing, and anchoring, contribute to market inefficiencies. According to traditional financial theory, markets are efficient, meaning all available information is already reflected in asset prices. However, behavioral finance suggests that market participants' biases can create mispricings where prices don't accurately reflect underlying values. This can lead to opportunities for savvy investors who are able to recognize and capitalize on these inefficiencies. Investors who understand their own behavioral biases can make more rational decisions, avoiding the pitfalls of emotional investing and exploiting market inefficiencies to their advantage. The chapter emphasizes that by acknowledging and mitigating these biases, investors can improve their chances of achieving better long-term outcomes. Key takeaways. 1. Behavioral biases impact decisions. Our emotions and cognitive shortcuts often lead us to make irrational investment choices. 2. Overconfidence and herd behavior. Investors can become too confident in their abilities or follow the crowd, leading to risky behavior and market bubbles. 3. Loss aversion. The fear of losing is often stronger than the desire to gain, leading to poor decision-making. 4. Mental accounting. Treating money differently based on its source or intended use can lead to inefficient investment strategies. 5. Framing and anchoring. The way information is presented and the first piece of information encountered can deeply influence our financial decisions. 6. Market inefficiencies. Behavioral biases create opportunities for investors who are able to spot and exploit mispricings in the market. Final thoughts. Behavioral finance uncovers the often hidden forces that drive investor decisions and shape financial markets. By recognizing the psychological biases that influence our choices, we can make more informed, rational decisions and avoid the common pitfalls of emotional investing. Understanding these biases doesn't just make us smarter investors, it makes us more aware of the factors influencing our financial lives. In the complex world of investing, knowledge of human behavior is just as crucial as knowledge of the markets themselves. Chapter 11, Potshots at the Efficient Market Theory and Why They Miss Efficient Market Theory. EMT often finds itself in the crosshairs of critics, professional investors, market pundits, and even academics. But despite the critiques, this chapter delves into why most arguments against EMT fall flat, exposing more about the critics' biases and misunderstandings than flaws in the theory itself. EMT, at its core, asserts that financial markets incorporate all available information into stock prices, making it nearly impossible to consistently outperform the market without taking on additional risk. Critics argue otherwise, yet their evidence often fails to hold up under scrutiny. The myth of the market profit. One of the most common attacks on EMT comes from believers in market gurus. These critics point to high-profile investors who have outperformed the market over certain periods, claiming it proves skill or insider knowledge. But the chapter dissects this phenomenon, explaining that the sheer number of market participants guarantees a few lucky streaks purely by chance. It's akin to a coin flipping contest. If millions participate, someone will flip heads 10 times in a row. That doesn't mean they're a coin flipping genius, it's just probability. When viewed through this lens, even the track records of celebrated fund managers can appear less remarkable. Many of their successes boil down to survivorship bias. Only the winners are celebrated, while the vast majority of failed investors fade into obscurity. EMT doesn't deny that some people will beat the market. It just argues that doing so consistently, in a predictable and repeatable way, is highly unlikely. The illusion of predictability. Critics also take aim at EMT by asserting that markets are predictable, often citing historical trends, technical analysis, or macroeconomic patterns as evidence. Yet the chapter shatters this illusion by highlighting the randomness inherent in markets. Events that influence prices, economic shocks, technological breakthroughs, geopolitical crises, are by their very nature unpredictable. Attempts to forecast such events with precision are doomed to fail more often than they succeed. Moreover, the chapter discusses how markets react to information. Even if a trend or piece of news seems like an obvious buying or selling signal, prices adjust so quickly that the opportunity disappears in a blink. Any predictability spotted in hindsight is just that, hindsight bias, the tale of behavioral biases. Another major critique of EMT comes from the field of behavioral finance, which argues that human irrationality can cause market inefficiencies. Investors are prone to cognitive biases, fear, greed, overconfidence, herd mentality, that sometimes drive prices away from their true value. While behavioral critiques are valid in highlighting these tendencies, the chapter explains why they don't overthrow EMT. First, even if individual investors act irrationally, their collective behavior often cancels out these biases. For every irrational buyer, there's likely a rational seller on the other side of the trade. Second, professional arbitrageurs step in to exploit and correct pricing errors caused by irrational behavior. These mechanisms help restore market efficiency over time, even if short-term deviations occur. Case studies that mislead. The chapter explores various proofs critics use to debunk EMT, such as bubbles, crashes, and anomalies like the January effect. But these examples are often overblown or misunderstood. Bubbles, while dramatic, don't invalidate EMT. They're rare and often fueled by irrational exuberance that's hard to predict. Likewise, market anomalies tend to disappear once they're widely publicized, as investors rush to exploit them, driving prices back to efficiency. The chapter emphasizes that markets don't have to be perfectly efficient at every moment. They just need to be efficient enough that beating them remains a monumental challenge for most. Why the critics keep missing the mark. Ultimately, the chapter argues that critics of EMT misunderstand its essence. EMT doesn't claim that markets are flawless or that prices reflect true value at all times. Instead, it asserts that prices reflect the best available information at any given moment, adjusted for risk. While inefficiencies exist, exploiting them consistently and profitably is extremely difficult, especially after accounting for transaction costs, fees, and taxes. Critics also fail to acknowledge that no alternative theory has demonstrated greater predictive power or practical utility than EMT. The financial world is filled with strategies claiming to beat the market, but their long-term success rates remain abysmally low. Takeaways for investors. For the average investor, this chapter drives home a powerful message. Don't waste time trying to outsmart the market. The odds are stacked against you, and even the so-called experts rarely get it right. Instead, embrace strategies aligned with EMT principles, low-cost index funds, diversification, and a long-term focus. By doing so, you harness the power of market efficiency to work in your favor, rather than fighting an unwinnable battle. This chapter isn't just a defense of efficient market theory, it's a call to action for investors to stop chasing illusions and start embracing the reality of how markets work. In doing so, it provides not only clarity, but also a roadmap for achieving financial success in a world where unpredictability reigns supreme. Chapter 12, A Fitness Manual for Random Walkers. This chapter is a practical blueprint for anyone seeking financial success in a chaotic and unpredictable market. While the previous chapters lay the groundwork by explaining the theory behind investing, this one gets hands-on, offering a fitness plan for your portfolio and financial health. It isn't about quick wins or chasing trends. It's about creating a disciplined, long-term strategy to weather the ups and downs of the financial world. Think of it as a personal trainer for your financial future. Start with a clear goal. The first step is to define your financial goals. Are you saving for a home, building a retirement fund, or creating a legacy for your children? Every goal has a timeline and risk tolerance that will shape your investment strategy. Short-term goals require safety and liquidity, while long-term goals can afford to ride out the market's volatility. The chapter emphasizes the importance of aligning your investments with your personal circumstances, risk appetite, and stage in life. Harness the power of diversification. One of the central tenets of this chapter is diversification, a strategy often called the only free lunch in investing. By spreading your investments across different asset classes, stocks, bonds, real estate, and more, sectors, and geographies, you reduce your exposure to any single point of failure. Diversification doesn't just manage risk, it also optimizes returns over time by balancing the winners and losers in your portfolio. The chapter provides an essential reminder. No one can predict which sector or asset class will outperform in the future. The smartest move is to own a little bit of everything, ensuring you participate in the gains while protecting yourself from devastating losses. Build a balanced portfolio. The chapter introduces the concept of a balanced portfolio, tailored to your specific needs. For younger investors with a longer time horizon, the recommendation is clear: lean heavily into stocks, which historically outperform other asset classes over the long run. But as you age, your focus should shift toward preserving capital, which means increasing your allocation to bonds and other safer investments. The chapter also stresses the importance of rebalancing your portfolio periodically. Market movements will naturally shift your asset allocation. Stocks might grow disproportionately during a bull market, for instance. Rebalancing ensures your portfolio stays aligned with your risk tolerance and goals, often forcing you to sell high and buy low, the golden rule of investing. Minimize costs, the silent wealth killer. Investment costs are often overlooked, but the chapter highlights how fees, commissions, and taxes can quietly erode your wealth over time. Actively managed funds, with their high expense ratios and frequent trading, rarely justify their costs. Instead, the chapter advocates for low-cost index funds and ETFs, which track the market as a whole and deliver solid returns with minimal drag from fees. The message is simple. The less you pay in costs, the more you keep in your pocket. Over decades, even a 1% difference in fees can add up to tens or hundreds of thousands of dollars. Embrace the long-term mindset. Patience and discipline are critical to success in the financial markets. The chapter encourages investors to resist the temptation to time the market, chase hot stocks, or react emotionally to short-term fluctuations. Trying to outguess the market is a losing game for almost everyone, and emotional decisions, whether out of fear or greed, often lead to disastrous outcomes. Instead, stick to your plan and trust in the power of compound interest. The chapter underscores that time in the market, not timing the market, is the ultimate driver of wealth. The role of risk management. Risk is an inherent part of investing, but it doesn't have to be paralyzing. This chapter teaches you how to manage it wisely. The key is understanding your own risk tolerance, not just in theory, but in practice. If a market crash would cause you to panic and sell everything, you're taking on too much risk. On the other hand, if you're young and financially secure, avoiding risk altogether could mean missing out on long-term growth opportunities. The chapter also introduces dollar-cost averaging, a strategy that helps mitigate the risk of bad timing. By investing a fixed amount at regular intervals, you buy more shares when prices are low and fewer when they're high, smoothing out your purchase price over time. Avoid the common pitfalls. The chapter concludes by warning against common mistakes. Chasing past performance, overtrading, and following hot tips are all surefire ways to derail your financial plan. Instead, focus on the basics. Set clear goals, diversify, minimize costs, and stick to your strategy. Another key point is staying informed, but not overwhelmed. Learn enough to make informed decisions, But don't obsess over daily market movements or the latest financial headlines. The chapter reminds us that most of what's touted as news is noise, and reacting to it often does more harm than good. Your financial fitness plan. Ultimately, this chapter lays out a straightforward yet powerful strategy. Set realistic goals, create a diversified and balanced portfolio, minimize costs, and commit to the long term. Like a fitness regimen, it requires discipline and consistency. There will be setbacks and temptations to stray from the plan, but sticking with it is the surest way to build lasting wealth. The takeaway is both empowering and humbling. You don't need to outsmart the market to succeed. By following these timeless principles, you can navigate the chaos of the financial world with confidence, turning randomness into opportunity and uncertainty into strength. Chapter 13: Handicapping the Financial Race. Investing isn't just about buying and holding, it's also about understanding what drives the returns of the financial assets you invest in. This chapter breaks down the fundamentals of projecting returns from stocks and bonds, helping you make more informed decisions. By understanding the mechanics behind these asset classes, you can set realistic expectations and build a more resilient portfolio. This isn't about fortune telling, it's about learning how to interpret the financial landscape and make rational choices. The engine behind stock returns. To understand what powers stock returns, you need to focus on three key components. 1. The dividend yield. The dividend yield is the income an investor receives from owning a stock, expressed as a percentage of the stock's price. Historically, dividends have been a substantial part of total stock market returns, providing steady income even during periods of slower capital appreciation. While today's dividend yields may be lower compared to decades past, their importance remains central to long-term wealth creation. Number 2, earnings growth. Stock prices in the long run are tied to corporate profits. When companies grow their earnings, their stock prices tend to follow suit. The chapter emphasizes that earnings growth isn't limitless. It's anchored to broader economic growth. Realistically, most companies will grow earnings in line with GDP growth plus inflation over time. Investors should be cautious about assuming double-digit earnings growth indefinitely. Those projections often lead to disappointment. Number 3, changes in the price-to-earnings P/E ratio. The PE ratio measures how much investors are willing to pay for each dollar of earnings. If PE ratios expand, stock prices can rise faster than earnings. If they contract, stock prices can fall even if earnings grow. While PE ratios fluctuate based on market sentiment and interest rates, the chapter warns against relying on them for long-term projections. Markets tend to revert to average PE levels over time, making massive expansions or contractions in valuations unlikely to persist. Stock returns. Adding it all together. When projecting stock returns, combine these three components. Start with the current dividend yield. Add the expected rate of earnings growth. Adjust for any anticipated change in the PE ratio. For example, if the dividend yield is 2%, earnings are expected to grow by 4% annually, and the PE ratio remains stable, your total return might hover around 6%. However, if the PE ratio contracts, that could subtract from your return, while an expansion could add to it. This framework helps set realistic expectations while steering clear of speculative guesses. The bond market's predictable nature. In contrast to stocks, bonds are more straightforward when it comes to projecting returns. Bonds deliver two sources of income. 1, the current yield. This is the interest income investors earn, expressed as a percentage of the bond's price. It's relatively predictable and reflects the bond's coupon payments. 2, capital gains or losses from interest rate changes. Bond prices move inversely to interest rates. If rates fall, bond prices rise, delivering capital gains. Conversely, if rates rise, bond prices drop, resulting in losses. The chapter emphasizes that bonds are a safer but less lucrative investment compared to stocks. However, their predictability makes them a critical component of a diversified portfolio, especially for risk-averse investors or those nearing retirement. The role of inflation in financial returns. No discussion of returns is complete without factoring in inflation. Inflation erodes the purchasing power of your money, meaning your real, inflation-adjusted returns are what truly matter. Stocks historically outperform inflation over the long term, but bonds and cash are far more vulnerable to its effects. This makes inflation protection an essential consideration, especially in environments where inflation expectations are rising. The chapter explains that nominal returns, the raw numbers reported, often look more attractive than real returns. However, as an investor, your focus should always be on preserving and growing purchasing power, not just stacking up nominal gains. The importance of discipline and realistic expectations. Many investors fall into the trap of expecting unrealistic returns, often fueled by market euphoria or misleading forecasts. The chapter stresses the importance of grounding your projections in historical trends and current market conditions. Historically, stocks have delivered average annual returns of about 9 to 10%, while bonds have offered 4 to 6%. However, these figures vary depending on the starting point. For example, if you're investing when valuations are high, low dividend yields, and high PE ratios, future returns are likely to be lower. Similarly, bonds bought during periods of low interest rates will provide modest returns until rates rise. By setting reasonable expectations, you avoid the emotional roller coaster of disappointment and rash decisions. What does this mean for investors? This chapter is a reminder that there are no shortcuts or guarantees in investing. Understanding how returns are generated helps you cut through the noise and focus on what matters. By dissecting stock and bond returns into their core components, you gain the tools to assess your portfolio's potential and adjust it as needed. For stocks, pay attention to dividend yields, earnings growth, and valuations. Don't get carried away by hype or short-term trends. For bonds, understand the current yield and the impact of interest rate changes. Bonds may not deliver the same excitement as stocks, but they provide stability and predictability. Always account for inflation. Focus on real returns, not just nominal numbers, to ensure your investments maintain their value over time. This chapter equips you with the knowledge to look beyond market headlines and focus on the long-term forces that drive returns. By internalizing these principles, you can navigate the complexities of financial markets with clarity and confidence, avoiding the pitfalls of unrealistic expectations and emotional investing. The financial race isn't about speed, it's about endurance, and this framework ensures you're equipped to reach the finish line. Chapter 14, A Life Cycle Guide to Investing. Investing is not a one-size-fits-all endeavor. Your financial goals, risk tolerance, and investment strategy evolve as you move through different stages of life. This chapter presents a life cycle guide to investing, designed to help you align your portfolio with your age, income level, and long-term goals. It's a practical framework that encourages disciplined, goal-oriented investing tailored to where you are in life. Hatch the foundation, risk, and reward across the life cycle. The chapter begins with an essential principle: the balance between risk and reward. Younger investors with decades ahead of them can afford to take on greater risk in pursuit of higher returns because they have time to recover from market downturns. Older investors nearing retirement should prioritize preserving capital over maximizing returns. At its core, the life cycle approach is about gradually reducing risk as you age. This strategy ensures that your investments not only grow when you're young, but also sustain you when you can no longer afford to endure market volatility. Your 20s and 30s, building wealth. When you're just starting out, time is your greatest asset. The chapter urges young investors to take full advantage of this by investing heavily in stocks. Historically, equities have provided the highest returns over the long term, and young investors have the luxury of waiting out market downturns to benefit from long-term growth. In these early years, you should focus on maximizing contributions to tax-advantaged accounts like 401ks and IRAs. The magic of compounding means that even small amounts invested now can grow into substantial sums by retirement. The chapter emphasizes that the most important decision at this stage isn't which stocks or funds to buy, it's getting started and staying consistent. Your 40s and 50s, balancing growth and stability. As you move into your midlife years, your financial situation becomes more complex. You may be juggling a mortgage, college savings for children, and retirement planning. At this stage, your portfolio should strike a balance between growth and stability. The chapter recommends gradually shifting some of your portfolio from stocks to bonds or other income-generating investments. Bonds offer lower returns than stocks, but they provide stability and reduce the overall risk of your portfolio. Rebalancing becomes critical during this phase to ensure your investments remain aligned with your goals and risk tolerance. This is also a time to take a hard look at your savings rate. Are you on track to meet your retirement goals? The chapter stresses the importance of staying disciplined with your savings and avoiding lifestyle inflation as your income grows. Your 60s and beyond, preserving capital and generating income. As you approach retirement, the focus shifts from growing your wealth to preserving it. This doesn't mean abandoning stocks entirely. Equities are still necessary to protect against inflation, but your portfolio should be weighted more heavily toward bonds, cash, and other conservative investments. The chapter introduces the concept of the withdrawal phase. During retirement, you'll need to carefully manage withdrawals from your portfolio to ensure your money lasts as long as you do. A common guideline is the 4% rule, which suggests withdrawing no more than 4% of your portfolio each year to avoid running out of funds. This stage also requires careful consideration of healthcare costs, long-term care needs, and estate planning. Your financial plan should include contingencies for unexpected expenses and a strategy for passing on wealth to the next generation. The role of index funds and diversification. At every stage of life, diversification remains a cornerstone of sound investing. The chapter champions low-cost index funds as the best way to achieve broad diversification across asset classes and markets. Index funds minimize fees, eliminate the risks of poor stock picking, and reliably deliver market average returns, which is more than most active managers can achieve over time. A well-diversified portfolio protects you from the inevitable ups and downs of individual asset classes. By owning a mix of domestic and international stocks, bonds, and other assets, you create a financial safety net that supports you through the unpredictable nature of the markets. The importance of discipline and simplicity. Throughout the chapter, one message stands out. Discipline and simplicity are key to successful investing. Avoid the temptation to chase trends or time the market. Stick to your plan, rebalance as necessary, and maintain a long-term perspective. Automation can be a powerful ally. Setting up automatic contributions to your investment accounts ensures consistency and removes emotion from the equation. Over time, this disciplined approach leads to steady progress toward your financial goals. Adjusting for life's twists and turns. No two life journeys are the same, and the chapter acknowledges that your plan will need to adapt to changing circumstances. Whether you face an unexpected windfall, job loss, or market crash, the key is to stay flexible without losing sight of your long-term objectives. The chapter also stresses the importance of emergency savings. A cash reserve equal to 3 to 6 months' worth of living expenses serves as a financial buffer, allowing you to weather unexpected events without dipping into your investments. The takeaway: a plan for every season. This chapter provides a powerful roadmap for building and maintaining financial security throughout your life. By aligning your portfolio with your age, goals, and risk tolerance, you create a plan that evolves with you, balancing growth in your early years with stability and income in retirement. The life cycle approach isn't just about numbers, it's about peace of mind. It empowers you to make smart, informed decisions, ensuring your financial future is as secure as possible, no matter what life throws your way. Investing isn't just a race, it's a marathon, and this strategy ensures you'll have the stamina to cross the finish line. Chapter 15: 3 Giant Steps Down Wall Street. As the final chapter, this is where it all comes together, a culmination of everything you've learned about investing distilled into 3 clear and actionable steps. Whether you're a hands-off investor, an aspiring stock picker, or someone who prefers professional help, this chapter lays out the path to financial success. Each of these approaches, indexing, thoughtful stock selection, or hiring professional advisors, has its strengths, but the overarching message is clear. Simplicity, discipline, and strategy are the keys to navigating Wall Street. Step 1: the no-brainer option, index funds. If there's a single takeaway from this chapter, it's this. For most people, index funds are the simplest, most effective investment choice. Why? Because they take the guesswork out of investing. Instead of trying to outsmart the market, index funds allow you to become the market. They replicate the performance of a broad index like the S&P 500, ensuring that your returns match the markets over time. The chapter emphasizes that index funds are not just easy, they're powerful. Decades of evidence show that the vast majority of actively managed funds fail to beat their benchmarks after accounting for fees. Index funds, with their low costs and broad diversification, consistently outperform these high-cost alternatives. And the beauty of this approach? It doesn't require deep financial knowledge, endless hours of research, or constant monitoring. Once you've set up your portfolio, you can sit back and let the market work for you. The chapter makes it clear. Index funds are the ultimate no-brainer for building long-term wealth. Step 2. The do-it-yourself option, stock picking rules. For those who are drawn to the excitement of stock picking and want to take a more hands-on approach, this step provides a practical framework. It's not about chasing the latest hot tips or relying on gut instincts. It's about applying a disciplined, evidence-based strategy to choose stocks with the greatest potential for long-term success. The chapter offers several guiding principles for DIY investors. 1. Look for value. Focus on stocks that are undervalued relative to their earnings, dividends, and assets. These are often overlooked by the market but can deliver strong returns over time. Avoid speculative story stocks with sky-high valuations but little substance. 2. Stick to quality. Invest in companies with a strong track record of profitability, solid management, and competitive advantages. Stability and reliability matter more than flashiness. 3. Diversify thoughtfully. Even as a stock picker, you must guard against putting all your eggs in one basket. Spread your investments across sectors and industries to reduce risk. 4. Be patient. The chapter stresses that stock picking isn't about making quick trades. It's about holding quality stocks for the long term. Ignore the noise of daily price movements and focus on the underlying business. While stock picking can be rewarding for some, the chapter doesn't shy away from its challenges. Successful stock picking requires time, skill, and a willingness to endure setbacks. If you lack any of these, or if you simply prefer a less stressful approach, index funds remain the smarter choice. Step 3. The substitute player option, hiring professionals. Not everyone has the time or inclination to manage their own portfolio. For those who prefer to delegate, this step discusses how to choose and work with professional financial advisors. But the chapter also comes with a caution. Not all advisors are created equal, and many fail to deliver value. Here's how to separate the truly competent advisors from the pretenders. 1. Beware of high costs. Many financial advisors charge hefty fees or sell products that benefit them more than you. Look for fee-only advisors who charge a transparent percentage of your portfolio or a flat fee, rather than earning commissions on products they recommend. 2. Seek fiduciaries. Choose advisors who are legally obligated to act in your best interest, fiduciaries, rather than those who operate under a lower suitability standard. 3. Demand transparency and simplicity. A good advisor will focus on low-cost, diversified investments like index funds, rather than pushing complex or high-risk products. They should also help you create a long-term plan tailored to your financial goals and risk tolerance. Professional help can be a valuable resource, especially for those with complex financial needs, such as estate planning or tax management. But the chapter reminds readers to stay vigilant. Your advisor should simplify your financial life, not complicate it. The final takeaway. This chapter delivers a powerful closing message. No matter how you choose to invest, through index funds, stock picking, or professional advisors, the most important factors are discipline, cost control, and a long-term perspective. There's no single right way to succeed in the markets, but there are countless wrong ways, often involving excessive fees, emotional decisions, and chasing trends. By following one of these 3 approaches, you can avoid the pitfalls and position yourself for financial success. Whether you embrace the no-brainer simplicity of index funds, the challenge of thoughtful stock picking, or the convenience of a trusted advisor, the path to wealth is within reach. The key is to start with a plan, stick to it, and let time and compounding work their magic. The financial world can seem daunting, but this final chapter reassures you that success is not reserved for experts or insiders. With the right mindset and a disciplined strategy, anyone can take giant steps down Wall Street and build a secure financial future. And that's it for a random walk down Wall Street. If you found this audiobook insightful, don't forget to hit that like button and subscribe to the Book Lounge so you never miss another chance to grow your mind and your library. Now, I want to hear from you. What stood out to you the most? Was it the concept of efficient markets, the importance of index funds, or something else entirely? Drop your thoughts, key takeaways, or even your favorite line in the comments below. And while you're there, let me know what book you'd love for us to feature next. This channel thrives on your suggestions. Oh, and before you go, I've got a special gift just for you. A free one-page summary of the audiobook you just listened to. It's the perfect quick reference for all the key points. You can grab it right now by clicking the link in the video description below. Thanks for listening, and until next time, happy reading and even happier learning.